All right, there we go. We are recording. So we'll begin tonight's webinar, the Monday member-only webinar. So, whenever, if ever, you have a topic that you want to go over, something that we don't cover enough, something that you want to go into a little bit more detail about, I'm always happy to give the webinars on Monday or whatever. It doesn't always have to be on Monday, where we kind of go over a little bit of some more key concepts where again, just don't have time to do it during the day because we're looking at flow and we're looking for trade ideas, and it's not the right time to kind of go over technical studies and so forth. All right, so I've given before, and I know that many of you have probably listened to them before. I've given, and so as with web as well, months back on the value areas, which I use a lot, and I'm going to go into why I use them. That's really so. There's a couple of things that I want to cover. I want to cover first of all the ones that I use, why I use them, how I got to that point of looking at the studies that I do use, and then also just talking about indicators in general. And so I want to gloss over that, and because I see so many advertisements out there for, I'm on mailings and so forth of this indicator will get you, can earn you big potential profits. And it's always, if you notice when people word these type of things, they're very tricky. It's a very it's a very I get the sense of like very sleazy sales whenever I hear potential profits, because they're getting around the legal. They can't say guarantee anymore because you can get sued for saying I can guarantee you profits. But if you say it open-ended, like potential, you can earn huge potential profits with this indicator. I would run for the hills if I ever heard that, and I would throw whatever it is right in the garbage. Um, so, so if you go into the webinar channel, so that's first things first. I feel bad for people who get suckered into thinking that this, whatever the indicator of the month club is that somebody is selling is going to all of a sudden magically create profits for them. It doesn't work that way. It does not work that way. There is so much more to trading that has nothing to do with indicators. So I'm going to try to roll that all into one, and we're kind of trying to cover that in about an hour. But I think we do have we got the options activity one. It's kind of hidden in here. It's called the value area webinar recording, spelled wrong, of course. My patented spelling, but that will really kind of go through. If you're unfamiliar, if you haven't seen these blocks on blocks or value areas on my charts, and you don't know what they are, then that's a good recording for you, because I'm not going to go into that level of detail into this. Okay, so let me first go into so what do I want to cover first? And I guess that's what I want to cover first is really, it doesn't matter which indicators you use, which technical studies. They're not indicators, they're really technical studies that you use. It's the ones that you do well at. It's the ones that you could perfect. Everybody has a different style. So if something works for someone, it doesn't necessarily mean that it's going to work for everybody else. It just doesn't work that way in trading. It's whatever you're comfortable with and whatever you can rely on where you're making decisions appropriately. Again, there's no indicator that's going to tell you to push the mouse to push the button to buy or sell. You have to be able to do that. If it helps you to have the technical studies on your charts to be able to make a decision quicker and make it more precise, both on the buying and getting out of positions, then yeah, then go ahead and use them. That's what they're there for. But they're not predictive. They're not going to generate profits for you. You're the one who is going to generate the profits. So, and I go back to, I'll kind of just give you a history of why why I only have these ones on my charts, which are still a lot. But I've tried a lot of different things before, and I got to the point where I couldn't see the price on the chart. And I've read books like, what kind of books can I tell you? most of the books that are in the books channel. Price is the most important thing to have on your charts. You need to be able to see the price. That is how you make money. Price is actually the leading indicator for a lot of things. So comic books, the turtle traders, really just being able to follow trends and being able to let your winners run is all about trading and making money. So price is the most important thing. What else? What are the reminiscences of a stock operator? There's a couple really important pages in that book about the less trading that you do is really the better. The profits are made in sitting and in patience. So that's my quick little 5 minutes. And those are great books. If you have not read those books before, either just the trend following book, as well as the reminiscences of a stock operator, as well as turtle traders. Those are three of my favorites. And then market wizards are very good as well. But for trend following, especially, in the markets that we're in right now, it has helped me so much to read those books and to get an idea of really how money is made with your trading and investing. So it becomes very difficult. You could do it. Everybody has a different style, and some people. So I don't want to criticize anybody who's making money in other ways. You could do it, obviously, day trading, swing trading, and so forth. But I've really found, the major money that I've made over the last couple of years is just sticking with the trends. And I use things like the 200-day moving average. We were having a nice conversation about that yesterday with Al, who's I'm very excited, came into the room on Friday. He used to. We actually ran in similar circles. We did not actually speak to each other when we were trading institutional money, but he was at Perry. And we used to cover, when I was at Merrill Lynch, we used to cover Perry. So we know a lot of people in common, and we've got a lot of things in common. And a couple of you have hit me with some side chat saying, hey, you guys ran in similar circles. And yep, absolutely. So just great guy to have in there. And I think from listening to him, if you haven't listened to his podcasts, he's got a couple on his Twitter page, just talking about getting better as a trader constantly. You always have to evolve. You never get to a point in trading where it's like, hey, I won. I figured this out. You're always trying to get better. So he's bringing certain ideas like channel trading and so forth, which is pretty good. That I'm enjoying learning a little bit about. All right. So a lot of so that being said, following the trend and so forth, a lot of my charts are set up that way. A lot of the indicators that I have on there are to help me really follow the trend, to see the trend, and to know where I can actually get involved in the trend. So let's start out with the moving averages. Let's talk about the ones that are in my upper chart. So really, the moving averages are just good guidelines for me. I think at any time, right? I mean, you could look. I think the easiest thing to look at here is probably to look at the S&P chart and look at it over time. I think it would have saved a lot of people a huge amount of money back in. Let's see if we could. How do I want to pull this up? Let's pull up a 30-year chart, or maybe a 20-year chart. Let's try a 20-year chart. Instead of the monthly, I want the weekly. Weekly, I think I can only do 10. So let's do monthly, I guess. Yeah, that doesn't even. They give me weekly. All right, we could still do it this way because we've got the 2008 and 2007. So really, what's helped is the 200-day moving average is really key for me, and has become a big part of my trading in the single names, but also in the major indices. Rather than trying to predict, there are so many people who try to predict what is going to happen next. And we try to look for clues about what the next major move is going to be, and if there's any hint of us being overbought. But really, price is the number one thing, and the moving averages really help. So where have the moving averages helped before, or the 200-day moving average? Where has that helped, and why I'm a big fan of the 200-day moving average? It really tells you if something is in an uptrend or a downtrend, and you could choose. It doesn't have to be the 200. It could be the 150. It could be the 300-day moving average. As long as you're using something to kind of tell you that a trend is either has been retaken to the upside or is breaking down. I like the 200-day moving average because I know a lot of people watch it, and I know that there's a lot of buyers come back into names around the 200-day moving average. But easiest thing I think possible is to look at where we broke down in 2006 and 2007. Depending on what you used, if you used the 50-day moving average, right, and that was your stop in the S&P, you could have gotten out with really no major impact. Let's say the 200-day moving average got you into the uptrend in the S&P. So maybe you use the 200-day moving average on the way out. So if you did that back in 2003, you got long here or somewhere in here, held the trend, and notice that we bounced here a couple times, so it may have kept you in here. We rallied back up to the 50 overhead supply. And then we finally broke the 200-day moving average. Notice we broke it, we retested, and then good night. So really that 200-day moving average, if you said, and again, this is just a guide, you have to actually push the buttons. You have to push the mouse and say, hey, we broke, and not say, hey, we broke the 200-day moving average. Oh, I think it's going to come right back. That's different. That's judgment. And, a lot of people have gotten into trouble that way. So really, to try to take the emotion out of this and to try to take, experience and knowledge can be a bad thing when trading, because sometimes, and I use the example all the time of Bill Ackman, right? Bill Ackman thought he was right forever, and he was wrong because he was using his personal judgment. He wasn't even using the simple 200-day moving average, and that would have got him out of Valiant, and that would have saved his fund, which it sounds like it's kind of in a little bit of trouble as they announced layoffs last week. But that's really, so it doesn't really matter what you use. It just matters that you're using something to tell you, hey, get out of it. And if you see in the trend trading portfolio that I have, I've got my stops in here, and I'm not really going to touch them unless I get a little bit overexposed, and maybe I'll take a little bit of a target here and there, like I did last week in EEM and MC and MCHI. I was just a little bit too overweight emerging markets, and also I think we're really extended. So you could use that as well, and you could be taking some profits here. So if we fast forward, right? So here would have been a great example where it just caused a lot of people to or would have really helped people not lose too much money back in 2008 and 2009. You would have missed this whole move. And that really got exaggerated below the 200-day moving average. So I use these a ton. It kind of tells me what's going on with the trend. It really helps me follow the trend. And, if you follow this example out, you'll see that once we retook the 200-day moving average, okay, this was a false move back in 2012, but you could have gotten right back out for a small loss as we rebroke the 200-day moving average. So this happens. Sometimes we'll oscillate back and forth before we really get going. And if you read books like The Turtle Traders, what they experienced is they experienced a lot of small losses and then a lot of big winners, because here, this, and again, what I like to do is set a little bit of a barrier below the 200-day moving average by using an ATR stop, the average true range of a stop, and you can multiply that by 1 or you can multiply it by 2, whatever you're totally comfortable with. Yeah, it's simple, right? And that's the whole thing. You want to have these things as simple as possible. There's no reason to get overly complicated. Trading is hard enough. It's hard enough to hit that sell button when we break the 200-day moving average. You don't want more and more things to tell you not to do it when you should. So yeah, keeping it as simple as possible. There's value in doing that. But here you go. So we've been in the uptrend, since 2011. If you're a trend trader, you've been holding all the way through. It's just what it is. It's just how it works as a trend trader. You've been holding all the way through. Now here we're extended, and you could use some things. You could ratchet up your stops. Same thing here. If you were riding the trend, maybe you got stopped out on the 50-day moving average. Did you lose out on this leg? I hope not, because if you stopped yourself out on the 50-day moving average, you should also be putting an alert right back in place, just in case of that whipsaw move, so that you don't miss it. You don't miss the rest of the trend. And I'll tell you, since I started this portfolio back in March of last year, I did that with a couple names. I got stopped out a couple names, and I kind of got a bad taste in my mouth, and I didn't get back in once it reclaimed those moving averages, and I really missed out. IBN was a really good one. So the best thing I could do is kind of give you examples. So IBN was a really good one. It's been basing here for a while, but I got stopped out on the 200-day moving average once it broke below. Where was this? Or was it the 50-day moving average? I think it was the 50-day moving average here, and this was earnings. So it actually broke the 50-day moving average, did not break the 200, and then it reclaimed it right back, and look at where it's at now. So, that was my fault. I did not want to get back in right before earnings. If you look on IBN, you'll see what I mean. Yeah, so I'm going to get to that. So I'm going to get out of this, so I wanted to cover the moving averages. I wanted to give you one more example. Yeah, I think it was here on the, it actually broke non-dividend adjusted. It broke through here on earnings, right on earnings. So that was a bit of a tricky move. That one I think was just a little bit unlucky. But you go to so where it's also useful is when we've been in uptrends. All year long we've been in uptrends, but I talk about the KWEB ETF, and every time this thing has come into the 50-day moving average, and same thing with Alibaba. I think just maybe once in Alibaba, Alibaba touched the 50-day moving average like basically once, twice, three. Here we broke and we reclaimed it. Here we broke it for a little while longer, and as long as you're putting that line in the sand of, hey, I'm going to get out here, and maybe I'm going to wait for it to get back above. But buying in uptrends has been, I would say the theme of 2017 was either, buying things in uptrends, on dips, buying dips in uptrends, I should say, or buying things that just started to get going for the first time. And we could go over example after example after example with that one, but I think most recently what got me into RSX was a break of the 50-day moving average. And so I'm going to get into the value areas next. Don't worry. Where's my RSX? So this was August 25th. Break of the 200-day moving average. And look at what it's done since. We had this one retest where I almost got stopped out. But look at this thing. 28 bucks. Oh, excuse me, $20, and now all the way up to 23, and now I'm in. And of course, what you could do with these, now that you're in the trade, you could ratchet up, just like you ratchet up your stops, your trailing stops. You could ratchet up the moving averages. So if the $200-day moving average got me into RSX, that could certainly, I could ratchet it up, and I think I now have the 20-day moving average, being that it's gone much higher than that. So I want to protect some of those profits. Well, yeah, I mean that's what I'm doing a little bit with the trend option portfolio. I'm going out. We could certainly go out a little bit further with some of those trades. I did the Delta one. I've done a couple other ones that are around July, August, but I could certainly lengthen the distance. But that's the whole idea, is to basically use this type of philosophy but use it with options. So that's the limited risk reversal, and that's why, those could also be, once I get further out, a couple months out, they could be rolled, just like we talked about with just doing BABA calls as well. So there's definitely management that we could do. I might be looking at that with Square. Square, my position expires in June. I probably will have to do some type of management before earnings. Okay, so that's the moving averages. They just have helped me a lot to stay disciplined. So what else do I have on the charts? On the top of the charts, I have the value areas as well. So the value areas, why is this important to me? Because it really tells me whether or not we're in a range market, we're in essentially a choppy market, or we're breaking out. And I think what you could have done here, looking at the S&P, is, as long as we're staying above the value area, I think you want to be long. Once we start to break into value, we've got probably chop and maybe some downside ahead of us. So they've really come in very nice. They can really come up with some nice support and resistance levels in addition to the moving averages. So the top of value, we see this time and time again, where we come back and we retest a level. So, and again, it's a little bit different of a concept because the value areas are volume at price. I think the moving averages look more at volume over time, right? So these are using volume at price, and it really comes up with some good support and resistance levels. That's really what I'm looking for, and I'm also looking for when we're trending, or when we're in a choppy market, right? I don't want to own things in a choppy market. I want to own breakouts. What could I show you? What would be a good example? I know we've got. I mean, I think this is pretty good. The XLV that we played in the trading room. XLV. We drew a resistance line, but it also came right into picture with the value areas. Once we started the month of January inside value, we broke above. That's it. So then use your top of value as your stop. Now you can't really use the top of value as your stop. It's gone. It's blown out. Now you have to use something else. And that's why the moving averages can come into play here, right? Because the value areas, once you start trading above value, awesome, right? You're long. Perfect. You found a breakout, play it for as long as you can, but the value areas, you're not going to take your stop all the way back here down to the top of value. Yes, the value areas are the box. Right, so this is top of value. Briefly, what this is: top of value, point of control, bottom of value, and this is essentially one standard deviation of the price from the previous period. So if you look at this volume profile, and you could actually see it pretty good here, you could see the volume right here, and you could see that we've got a developing value area for the month of February, which is going to be upon us. But it's basically taking one standard deviation of all the volume and putting support and resistance around there. But yes. And you notice the tighter these boxes are, the value areas. And this is a concept that I'm saying boxes because I've seen other people use. They hand draw these, and they're not as precise as what we use. But they're basically looking for breakout areas. So here you definitely got it. Now I think MGM was another good one. This one was a little bit tricky around the value areas. You could have used the past resistance here, and so on and so forth. I can give you another example of one that I used last year, and they also work. What's the most important value area is the year's value area, and that can be seen on the weekly chart. So, for example, where this was really good is because there's something called the 80% rule. So there's once we got into this was all the way back. So this we're in 2018. This was 2017. This was 2016. Notice that we came from a big downtrend. We got into value, and the 80% rule is once you're firmly inside value, there's an 80% chance that you cross all the way from the bottom to the top. And XME did that. So that was a great place to take targets. You could see that's exactly where we stopped at the top of value in 2016. We spent a little bit more time inside, and then we broke out and we went at the end of 2016. And then we kind of stalled out here. I think maybe we stalled out here. But notice what we did here. There was a lot of pressure going on here. And this was a great, so, if you like to sell put spreads, if you like to do that type of a trade, using the value area support is a great place to do it because you've got good resistance. Notice the time frame, and I remember talking about this last year, but this was May. It took us a long time to all the way to get a little bit of distance. We had one bar that we closed right at the top of value in June, and then we just kind of came back. And notice there's a 200-day moving average here as well. But this acts really well for that support. And it works very well on anything. I could show you another great example. But yeah, I mean, again, you have to, if the price breaks into value and you're short a put spread, then you've got to manage it. Right? Then it's up to you if this did not hold. But this was a great level to sell a put spread against, and since then we've made some strong moves, and we've stayed in value. Notice we never even got into the 2018 value area, and look at how far above we are. Yeah, so I'll go over all the moving averages that I use as well. This was another great one that Webb and I had tried a couple times. We had some conversations back in 2016. Copper was in this long downtrend, right? And then look at it. It was pushing on the top of the bottom of value for almost the whole year. February. Look at this level of resistance. So you would not have been able to find this basically anywhere else. Notice, this is again is a weekly chart. So 1, 2, 3, 4 weeks, 5, 6, 7, 8, 9 different weeks. We could not break into it. And then once we finally did, look at what happened. 80% rule, we basically crossed all the way through the value area. We opened up 2017 above value, and we never really got even close to it. Right? So that copper was phenomenal. And we had tried a couple trades here, and I think we got stopped out in copper because we got a closing bar in here barely, and I think we just didn't wait for it enough. But we were watching this thing for weeks on weeks. All right, so what moving averages do I use? So I like the basic ones, and this is why I have two sets of charts. For the longer term ones, I've got the 200. You can look at XLU. XLU is another good example, by the way, because a lot of people are talking about XLU, so I'll bring that chart up. Dividend adjusted. So I use the 200, the 100, and the 50. I really tend to use the 200 and the 50 the most. If we start to break, if you break the 100 and you're looking for another area of support, I bring the 100-day moving on, the 100-day moving average in my Thinkorswim charts. It's built into Bloomberg, so I leave it. But you can see the XLU ETF, and we'll use this on the daily chart. Good example. We broke decisively the 50-day moving average. We broke the 100-day moving average. I would have said haven't been in this XLU, but I would have said the 50-day moving average, because this thing has respected the 50-day moving average several times. once, even the 100-day, or even if you got in on the 100-day moving average, been riding it, good night, get out in my system. And look at the break of the 200, retest, and fail. It even got a bid last week, and I just didn't want to put, I know we had talked about it, XLU, a couple times, and I thought it was due for an oversold bounce. But sometimes and this is really tricky, when you're trading counter trend, sometimes the bounce, that's it. That's your trade. This big white bar, if I was trading this counter trend, and again, why is it called counter trend? Because now it's below. You're going long in a downtrend. So that's counter trend. You're going against the predominant trend. If I would have tried this for a bounce to go long XLU, I would have been out on this candle. I wouldn't even waited for this. I would have taken my money and run. And then we'll see what happens. If it reclaims the 200-day moving average, go long utilities again. And again, here's where it comes into the trading plan is more important. What size are you going to take in a counter trend trade? Is it your normal trade that you were going to look for a bounce on the 50 or the 100-day moving average? For me, what has helped me a lot is because I'm more of a trend trader and I know that I'm a better trader trading the trend. If I take, just for round number purposes, if I take my normal trade size is $10,000, maybe for for uptrends and buying the dip in uptrends, maybe for a counter trend trade I only take 25% of my normal size and take it for $2,500 because I view it as a much riskier trade. And you could see a lot of things going on here. You could see the 50 crashing below the 100 now, which is a death cross. All right, so that's the long-term averages. So what do I got? What do I have going on in the short-term for the short-term moving averages? I still have the 200 and the 50. You don't see the 100 here. And then I've got some shorter dated moving averages. So why do I have the shorter dated moving averages on here? I've got the 20 and I've got the 5-period exponential moving average. The blue is the 20. And again, it just helps me see the trend. And we've got the 5. So notice that we've been following this 5 all the way along, even though people have said a couple times that there's been reversal bars in here. But we've never broken the 5. And we still haven't, even today, even with today's price action. We have not broken the 5-period exponential moving average. No trend have we broken. Now, I think once we duck below the 5, great place to probably take more profits. But it's been great to follow this all the way through. Obviously taking profits as we go along and doing the rolling out and rolling up in some names where I think it could keep going. But if you would have told me here, I don't know, or here, like, oh my God, this thing, we're overbought. Look at how overbought we got. We're still overbought. But it really helps me. I kind of even view them as training wheels. Right? They keep you in. If it keeps you in the trend, use it. Right? There's going to be one day, and we talked about this a few times last week, but I wanted it to sink in with people and traders in the room that there is going to be one day in the uptrend. You're not going to be able to predict it. Unless your crystal ball is working really well, but you're at the end of a trend, you're going to have a day that has losses. So you have to be a little bit comfortable with that to know that you can't be that afraid. Like as a trader, you cannot be that afraid of losses. Because if you're that afraid of losses, you'll miss all the gains. So this is what's kind of keeping me in the game until this kind of stays above. I don't know what happened with Trade Alert here. You have to be able to sit with some risk. So maybe losses is the wrong way to phrase it, but it's risk. You have to be willing to sit with some risk as a trader. If you are constantly afraid of a loss, you're going to drive yourself nuts. And there's times where you're going to be more. I talked about it last week. I was feeling a little bit uneasy about holding a lot of positions. And if you feel uneasy, you could take some positions down. But that's part of the game is risk. So, I think some people have again different strategies than I do, and that's fine. Some people are more day traders because they're too afraid to sit with overnight risk, or they're not comfortable with it. Maybe they had a bad experience. I see nothing wrong with starting the day as a day trader, taking half your position off, and then letting the rest of it run. But again, that's outside what I wanted to talk about tonight. This is more about the technical studies. So those are the two that I really use, and I've used a whole bunch of other things. I've used Bollinger Bands. I've used just a whole bunch of different things. The Ichimoku Cloud. I've tried all that. By the way, the Ichimoku Cloud. It sounds sexy, doesn't it? It's just a series of moving averages. That's all it is. It's not anything more than that. It's a couple different moving averages, but it's just a series. And if you look at the Ichimoku Cloud, you'll see what I'm talking about. And it will give you, again, it gives you a good signal to stay. Like if the price gets into the cloud, you don't want to be in it. It's kind of like the same thing. If the price starts to break below my moving averages, I don't really want to be in a gap in here. That's going to be chop. Same thing with the value areas. So they kind of do the same things. It's all about what you're comfortable with using and what you're good at. And whatever, again, can help you click the mouse when you should be. Use whatever it is that helps you. These help me tremendously because I see different things a lot of times. The V-pocks are really great because I do believe that the way that hedge funds trade, they respect different price levels. I think FCX was the last. We hit this V-pock, and that was a great place to take some profits. If you're in stock, I didn't take any profits here, but options where they have a definitive where that they're going to expire at a certain time frame. So if you're in a February position, what a great place to get out of your position, or at least take a big target. And know where to kind of get out of it, even know that there's no support has been broken. Again, you don't have to get out of the whole thing. Any take on Fibonacci? I used Fibonacci for a little while, and I'm just more comfortable with this system. Sometimes, there's some indicators that I found that get me out of profitable trades too early. So, fib extensions and so forth. PSAR is another one that I used for a little while. I think PSAR is pretty good, but PSAR gets, like, once you see a trend change, people get out. They're like, oh my God, I'm out. And then 2 days later, it reverses and it goes back up. So that's why I don't use PSAR either, because it keeps me out of profits. I don't want to put things on my charts that are going to. There's great when it alerts you to when something is really being broken, but in my opinion, I want to ride the trend, and I don't think PSAR. PSAR is great for getting you out of a swing, I would say, but the trend can reverse rather quickly with those PSAR dots. And I think with the fib levels too, it's nice support and resistance levels, but we've seen price get over fib extensions. But it's great to know where things. I think they're very good for noticing where there's going to be another area of digestion, and I think the fibs are good for those. So the VPOC, going back to the value areas, the value areas are created from value at price. And just a real quick explanation, it's where price really moved quickly. One side, either one side or the other. In this case, all these VPOCs came from the price moving down very quickly back when we had 2015 to 2016. And what happened was all these areas where buyers and sellers lived, price went all the way through there very quickly. So every time that we went through levels that we never hit before, so these will come back into play at some point. Here was another one, that we hit from back here. So that's the best way I can explain it. There was a lot of buyers and sellers that met up previously, and price has not returned to there. So what happens when price comes back to there? Sometimes you get a fade. Not always. I would say, and I wish I had a better percentage for it, but I would probably say around the 70% ballpark that we get once price. I mean, here we kept going, right? And this should have been an indicator. Like if we hit one of these V-pocks and the next day we gap above it, I think this becomes less relevant. The very next day it gapped above, and I would have said, forget about this. That's gone. This one, like on the day, we hit it and we touched and we reverted. We just spent a little bit of time. So it doesn't mean that the trade is over. It's just a great place to take a target. Same thing with here. We eventually got back above it. I mean, you could do that, as well as, but sometimes the price moves very quick. But you could say, hey, I'll get out of it, and once we reclaim it, I'll get back in. Right? But they're exceptional for noticing where buyers and sellers have been before, because, and again, it's intuitive. Some people, let's say if somebody bought here, right? Let's say a hedge fund decided to buy here at this price at 1582. Remember, not everybody trades rationally. So let's say there was a big, there's a lot of buyers and sellers here. Somebody bought a lot here at 1580, at 1563 or something like that, in that range. Once the price got back, maybe they had a limit order to say, hey, if I ever got back to my purchase price, I'm out. I'm out of this thing. And that's why you could see some volume there, right? I mean, that's how people behave. People are like, hey, if I could only get back to where I got in, because this person is underwater all this time. A lot of times what hedge funds do is they will give their broker an order to buy 100,000 shares at X amount of price, and if the price starts going up, they're like, hey, well, I'm only going to sit with 100,000 right now. If we happen to get back to that price again, I will buy another 100,000 shares. So they're like, hey, keep that in mind. Alert me to the fact if we ever start trading, below $17 again in FCX, I'll be a buyer there again. So there's buyers and sellers that live at different prices, right? It's all about demand and supply. So there's certain places where the supply is bigger, and we found that V-pocks really work very well. Again, virgin point of control, purple lines. All right, any questions so far? I think that's everything to kind of cover on my upper studies, which is the majority to spend the most time. So, and again, I encourage you guys to try different things, to try different indicators to see which are best for you. It took me a long time. Again, I tried basically everything until I got to the point where I really was at a very high comfort level with what I'm doing. And that's why, like, I wouldn't want to bring something else in here, because I've got I've got the system down. If you want to tinker with your system more, then you could try different indicators and so forth. But I've got my system down. Like, I know what I should be doing. Again, I still have to click the mouse, but I've got my system, very, very, maybe I want to tinker with another 10% of it at some point. But I'm where I want to be. And once you have that confidence as a trader that what you've got is working for you, confidence can be a really great thing. Because what happens when you build that confidence, you'll realize that you have such good confidence in your trading system that it helps you to take losses in certain names. And you can be like, oh, well, I got unlucky in this particular name, but my trading system is really working. So again, every time you get into a position, there's no 90% certainty that it's going to work, and the indicators are not going to help you create, when you get into a trade, that it's going to have a 90 or 80 or 70% outcome that the trade is going to work. If anybody has ever told you that, that's bullshit. Um, what your studies will tell you to do is to manage those trades appropriately so you don't have any big losses. But again, that's, you have to push those buttons. And even the best traders of the best of the best, maybe you're a little bit better than 50%. Believe it or not, most of it is a flip of the coin. And it's really how you manage your winners and your losers. That's what it's all about, regardless of how great the setup looks. All right, so the other thing is, regardless of how great a setup can look, using the same amount of money, risk adjusted, also helps. I've seen trades hit the tape, and I've seen charts where I'm like, oh my God, this is the best setup. I got the value areas, the moving averages. But where I've gotten into trouble before is by saying, oh, I'm going to double my size in this trade. It's still, they're not predictive. They're just going to give you good levels of support and good levels of resistance, and you have to respect them. Mark. But that's all it is. And I hate, like, I hate to break it to people, but there is no magic indicator. There's no magic study. You have to be able to, it's all about how you can manage it in your trading system. Because I think people are still looking for the Holy Grail. And so again, trying different things. I'm all about it until you perfect that system. And as you try different things, just make sure you size down. You size, like I said, if your average trade is $10,000 and you're trying something new, only do $1,000. Or if your average size is $1,000 per trade, try something new with 10 or 20% of that, and keep trying it until see if it works. And it's part trial and error. It really is. I mean, I've been doing this for a long, long time, and I've tried a lot of different things, and it's good. You do want to try different things, because we're always getting better. Like Al's in the chat now, and he's talking about channels. So that's something that I want to kind of look as well for swings, and maybe for option strategies. We're talking about 1x2 call spreads, around channels. I think that is something that I would probably add to my repertoire of trades that I could do. I think that makes a lot of sense. All right, so what else do I have on my charts? Of course, I have volume down here. I have the RSI, which, previously, I mean, I think the RSI is not really working right now. We've been overbought now in the S&P for a long time. So, I'm starting to use the RSI less and less in terms of taking exits when we get overbought. Clearly that was a good thing to do in the past, with the major averages, especially and with sectors. Normally they didn't spend too much time in overbought areas, but not everything is going to work in every environment. We're in a different environment right now. It just is what it is. Look at how overbought we've been. So if you got out here because of the RSI was overbought, that didn't work for you. Didn't work for anybody. But when things, so maybe, what I started looking at was, okay, maybe it's not a 70 or 75 RSI, but maybe it's an 85, right? These things I mean, we got to an 89, I think, on Friday. That's extremely extreme. So that can kind of help you, to basically say, yeah, what did we get? We got to an 87 RSI. That's the most I think we've ever been overbought. So that could kind of tell you, like, hey, how much further are we going to go here? And you could see that we burned it off a lot today. I mean, again, in the grand scheme of things, were you, or how much of a hero were you if you sold everything on the Friday's closed? We're only down 0.75%, and we're still in the uptrend. And again, this is the S&P. This is not every stock. So sure, I mean, that's what I did with EM too. I did not time this perfectly. I think I did it here. We went up a little bit further, and I sold out of EM. Just too far. Two things, a couple things. So the value areas aren't going to help me anymore. They were great here, but that's it. They're not going to help me anymore on this chart. What's going on here? Right? So they have their use, but once we're trading outside of range, they're that's it for those. So I need something else. So the moving averages. Notice that we're starting to duck below the 5. But hey, look at the distance between the 5 and the 20. A little bit too extreme for me. Also, the RSI was too extreme for me. Also, in portfolio management, I think I had 38% of this portfolio. What is going on? 38 of this portfolio was all in emerging markets, in different things, but all in emerging markets. So that was a right place for me to take down just a little bit of exposure. And again, I'll get right back in. I'll get right back in if we get, maybe 1 or 2 more days of a dip, maybe someplace back to the 20. That would be a great place to try that. Remember, we've been seeing all these EM orders. So there's a big appetite for emerging markets right now. So would love to get in back in there. So that's the RSI. Again, good for telling you when things are getting a bit too extreme. And then finally, just the MACD is what I like to use. I think it's really good. It's not predictive, but it just kind of gives you a heads up when a trend is changing. And that's been very good. Especially, that's helped me a lot on these breakout trades. Right? How great was this one? And I think we put this in the newsletter. But you had a breakout. So you had all these things going on. You had a break of the value area. You had a break of a trend line. And you had a new MACD bull crossover, just indicating that something was going on. A trend change was going on. I mean, how great was that trade? Crushed it. Absolutely crushed it with that trade. Same thing with MGM. MGM, this was a little bit more difficult because the MACD lines were so kind of clustered together, but you could see the separation here. So that's kind of just anything that will tell me that that something is going on that's different. DWDP wasn't a great one either. I guess you could have initiated the trade here, but I waited for the breakout for Dow DuPont. That was another one, and we saw this over and over. How many patterns did we see this in? Long sideways base and a break higher. CCL was another great one. I mean, look at the moving average. This was, I guess you would say, coiled. I guess some people use that. Big old coil and then a break through this. I think this thing still wants to go. We saw a roll today in DWDP. How do I use volume in assessing potential trades? That's a great question. You definitely look for a difference in volume on the move too. That's great confirmation. I know people look at that as well. Some traders are really good at just picking up on volume. I think that's a great confirmation once you start to see a little bit of a breakout. We use that for obviously for options too, right? When we start to see call buying, an expansion in the call buying, that's a great volume indicator as well. But you could see there's a little bit of a pickup here and there. It's not huge, and that's why I don't use it. XLV, I don't know if we got an expanding. Yeah, I guess things really got low in here. So I do use it a little bit. It's definitely not the only thing that I use is the one on the bottom. But it helps. When you see that volume pick up on a breakout, it could get pretty powerful. All right, so we went an hour. I think that was perfect. I hope that was good for you guys. So let's go into questions. Any questions that you guys have? The other thing, you see all these V-pocks down here? You don't have to worry about these until we break a value area to the downside. So you could just kind of forget about these. Where they come into play is when we break a range. Break the value area. Then you have to worry about it. Just like with Win. Win is a good example. We're now in value. So where would you want to set up a trade? Top of value. Then if you go to a smaller time frame. But again, if it breaks, it breaks. You got to get out. There's one that was hit at the end of the day here today. So I jumped in. I was in a little bit too early. So I went against, I don't know, it was late in the day, Friday. I guess I was feeling a little bit, feeling pretty good on Friday with the way I was trading. Probably was a little bit too aggressive in hindsight. I sold some put spreads and Win. And yeah, these things usually they take. War Eagle had a great point about this one. We debated this in the room Friday afternoon, and you guys it was a nice conversation talking about what this would do to Win stock. And I go back to the 3-day rule. Bad news comes out. Give it at least 3 days. So many traders, they want to just go and they want to, as soon as they see a dip and a red candle, because let's face it, this market has been a lot about buying dips. But as soon as you see a red candle, I was in somebody's private Twitter room a while ago, and I had to get out of it because the traders that were in there, every time they saw a red candle, they would just buy. They had no support at all. They were just buying just because they knew the stock and it was down. I was like, you guys are going to get crushed. I was like, get me out of here. So, the Win trade I put on Friday was a 3-lot. So, it sucks. But I did not put on a humongous trade. I don't do that with those put spreads. Yeah, and that's another thing. If the studies kind of slow it down for you a little bit, it's you get more confidence as a trader when a stock's falling. And I think a couple of you guys did it who did not participate and Win. Let it. Usually, I think it's more rare to get a V recovery. It's usually a recovery that just takes a long time. It doesn't come back right away, but it bases and then it comes back. Celgene is probably a good example. Celgene broke below the 200-day moving average. The problem is to go long for a counter trend, it's got such a big distance between here and the 200-day moving average. What I did way back when, is I use the value area. Notice what we did here on the weekly chart and win. And I sold put spreads here. I got a little worried, I think, here, and I took the trade off for profits. But that was a great area to trade against. I mean, that's good support. Whether it holds is a whole nother story, but at least you know that this is a good level to trade against. And if it breaks, then get out. These levels, they get broken. They're not magic. If there's enough sellers, they will take it down. So they're not gonna stop selling because there's a stop. There's a line on a chart. But it could be where buyers come back in, right? And that's the whole thing with the value areas. I'm one of the anything else? Any other questions? Any other? All right. So the takeaways, I think, from this is, I hope you learned a little bit about some of those studies that I use. And again, I'm not saying that these are the best in the world studies. It just helps my trading and it helps my system. There are tons of other studies you can play around with. Whatever gets you to making more money and making better decisions, getting out of trades that don't work for small losses, and then letting the winners run. All right. Anything else, guys? And any other questions? Good? Okay. Great. Cool. You could always email me. You could always hit me with a private message for those who are who will be watching the recording later. Happy to go through and talk more about this stuff. All right, guys. Have a great night. See you tomorrow.